Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared.
Yeah, we're glad you're here.
Definitely. And today we're doing a deep dive into a process that honestly strikes dread into the hearts of so many business owners.
Oh, for sure. The monthly financial close.
Exactly, the monthly close. And we are actually pulling our insights today from an expert source guide provided by the team at Wilber and Longenbaugh. You can learn more at www.mwwcpa.com.
It's a great resource.
It really is. So our mission today is to completely demystify this because, it sounds like this really dry, routine accounting chore.
Right, like just something you have to do for the tax man.
Yeah, exactly. But we want to reveal why it's actually the foundational engine for your entire business strategy.
It really is.
So to understand the stakes here, I want you to imagine you're a pilot. You're flying a passenger jet at 30,000 feet. The skies are heavily overcast. You can't see the ground at all, but you feel completely calm.
Because you have your instrument panel.
Exactly. You have this beautifully illuminated instrument panel right in front of you.
Right, and you just trust it. You trust the altimeter, the artificial horizon, the fuel gauge, and the data those instruments provide, it's basically binary.
What do you mean by binary?
Well, I mean, they're either functioning flawlessly and you're safe, or they aren't and you are in immediate danger. There's no middle ground there.
Wow. Okay. But consider what happens if you, suddenly notice the fuel gauge is stuck or the altimeter is lagging by 10 minutes.
You wouldn't be calm anymore, that's for sure.
No. You wouldn't confidently accelerate or, execute a steep climb. You would freeze. You'd literally be flying blind.
Yeah. And that feeling of flying blind, that is precisely the strategic risk you take as a business owner when you treat closing your books as an afterthought.
Which so many people do. They just assume it's happening smoothly in the background.
Oh, all the time. And that background assumption, it's a really dangerous psychological trap. Well, business owners will go out, they'll purchase accounting software, link their bank feeds, and just assume the math is doing itself.
Right, like the software is just handling it.
Exactly. And look, software is an exceptional tool, but it is not a substitute for a verified process. Before we even get into the weeds of how to do a monthly close, we really have to recognize its strategic imperative.
The why behind it.
Right. The close directly dictates your ability to make safe, aggressive business decisions.
I want to dig into that a little bit
Yeah.
because linking a bank account to, say, QuickBooks, it creates this really powerful illusion of control.
It does.
Like a founder logs in, they see a positive cash balance, and they're like, great, we are operating profitably.
Yeah, and operating solely off a bank balance creates a profound false sense of profitability. It's so common.
Because that cash isn't necessarily yours to spend.
Exactly. A high cash balance might include customer deposits for work you haven't actually performed yet.
Yeah, right.
Or it might be masking massive quarterly tax liabilities or vendor bills that just simply haven't cleared the account yet.
So it's a mirage.
Completely. We frequently see companies delay really critical strategic moves like hiring a key executive, opening a second location, or maybe upgrading their tech stack.
Just because they don't know if they can afford it?
Yeah, simply because their internal financial data feels inherently shaky. They just don't trust it.
That makes so much sense. If you're hesitating on a pivotal hire because you aren't certain you can absorb the payroll increase, well, your competitor who actually trusts their financial modeling, they're making that hire.
And they're capturing market share while you wait.
Right. Hesitation costs momentum. So avoiding the monthly close isn't just like an administrative failure. It's a massive strategic vulnerability that actually costs you money.
100%. A lack of trust in your financials directly translates to a loss of competitive advantage. Yeah, when your data is opaque, your risk tolerance just plummets. Clean, verified financials provide clarity, and clarity fundamentally reduces operational risk.
Okay, so since trusting that instrument panel is so critical, let's break down the actual anatomy of a clean close.
Let's do it.
The Wilber and Longenbaugh guide outlines 4 specific non-negotiable components that you have to verify every single month.
Yeah.
And I think a lot of people assume that just clicking reconcile in their software covers the baseline.
Yeah, they do. But the source insists on strict bank and credit card reconciliations, and clicking the button is really merely the starting line.
Wait, really? What else is there to do?
Well, reconciling requires verifying that the transactions recorded in your general ledger match your actual bank and credit card statements down to the exact penny.
The the exact penny.
Yes, every single account must align. You have to leave zero unexplained differences.
Okay, I have to challenge that strict $0 rule.
Okay, go for it.
Because if I'm looking at a $50 discrepancy at midnight on a Friday, the overwhelming instinct is to just write it off.
Oh, to just call it a rounding error?
Exactly. Or like a misplaced software subscription receipt,
Yeah.
just plug it, close the books, and go home. Why mandate such a rigid standard for such a tiny, immaterial amount?
I get that. But a zero balance discrepancy rule isn't actually about tracking down $50.
It's not.
No, it's about the reality that multiple massive transactions could be masking one another within that tiny net difference.
Oh, wow. Like what?
Well, you could easily have a $10,000 client wire that failed to record in the ledger sitting right opposite a $9,950 fraudulent vendor withdrawal.
Oh, my gosh.
Right. So the net difference appears as this minor $50 variance, but your data is actually fundamentally corrupted.
That is terrifying.
It is. The $0 rule is what proves the integrity of the entire data set.
Okay, that totally changes how I view that Friday night $50. So reconciling the bank ensures the cash you claim to have today is actually there. But a perfect bank statement still doesn't tell me if my clients are actually paying their invoices on time, right? Like reconciled cash is just a snapshot of the past.
Exactly. And that transition from historical cash to future liquidity brings us directly to the second checklist item, the accounts receivable and accounts payable review.
AR and AP.
Yes. And this step requires moving way beyond simply glancing at an aging report. You have to tie those outstanding 60-day invoices directly to your immediate cash conversion cycle.
Right, because a company could say, generate $1 million in sales on paper for a given quarter.
Easily.
But if the AR review reveals that major clients are stretching their payment terms from 30 days out to 90 days, that $1 million is functionally useless for meeting this week's payroll.
Exactly. You can't pay your employees with an invoice. The AR and AP review forces you to confront the reality of your working capital.
And what about the AP side?
Well, if you aren't aggressively tracking accounts payable during the close, you might miss that a critical supplier is threatening to halt shipments.
Just because an invoice was misrouted and didn't get paid?
Exactly. And suddenly your entire supply chain stops over a clerical error you missed during the close.
Man, this really highlights the operational hazard of managing a business based strictly on when cash moves in and out of the bank.
It really does. Which is why the source material emphasizes the third component, recording expenses and revenue properly.
Right, and this specifically highlights the mechanics of accrual accounting, which for non-accountants is a major aha moment.
It changes everything. Accrual accounting is the mechanism that matches the economic reality of a business event to the month it actually occurred in.
Totally independent of when the cash actually changes hands.
Right. It's called the matching principle, and it's what prevents these wild, artificial swings in your profitability metrics.
Let's run through a practical scenario for the listener, just to illustrate how cash basis analysis can kind of destroy decision-making during a growth phase.
Okay, I love a good scenario.
So suppose you run a commercial architecture firm, and you execute this massive, resource-heavy design project throughout December. You pay your engineering contractors, you absorb the software licensing cost, you deliver the blueprints.
So tons of expenses going out the door in December.
Exactly. But because of the corporate holiday schedule, the final invoice goes out in January, and the client doesn't remit payment until February.
Ah, I see where this is going.
Right. If you view that timeline strictly through cash, December looks like a catastrophic loss. Immense payroll expenses with zero revenue.
And then February looks like a spectacular windfall.
Exactly. Which is just not reality.
No, it's not. And attempting to make strategic decisions based on that distorted cash view, well, it leaves leadership paralyzed in December thinking they're going broke.
And then dangerously overconfident in February, right? They might go buy new equipment they don't actually need.
Exactly. Accrual accounting corrects that timeline distortion. During the December monthly close, you record the revenue because that is the period the work was performed.
The value is earned then.
Right. And you accrue the corresponding expenses in the same period. This smooths out the financial picture, so it actually reflects your firm's operational performance.
It strips away the illusion created by administrative billing delays. I love that.
It's crucial. But once you secure that comprehensive picture, the reconciled cash, the working capital and AR and AP, the accruals, you still need a final safety net before locking the month.
The fourth step, the financial statement review.
Yes. The financial statement review serves as that final net. You generate the profit and loss statement, the balance sheet, and the cash flow statement.
And what are you doing with them? Just filing them away?
No, this is the stage where you apply a human sanity check to the complete data set. You're looking for operational anomalies.
But wait, what specific anomalies are we hunting for here? Because we've already verified the bank balances down to the penny, we chased down the invoices, we applied the accruals. Isn't the data good?
Well, you're looking for trend breaks and misclassifications that software rules simply cannot contextualize.
Oh, like big spikes or dips?
Right. Did your legal and professional fees suddenly quadruple compared to your trailing 6-month average?
That would be a red flag.
Exactly. Or did an automated bank feed map a $30,000 server purchase to office supplies?
Oh, yikes. Instead of a capital expenditure on the balance sheet.
Yes. The financial statement review catches these fundamental structural errors before they become permanent historical records.
Which brings us to where this entire system typically breaks down in the real world. Because knowing the theoretical architecture of a clean close is very different from executing it consistently amidst the chaos of running a company.
Oh, without a doubt. The theory is easy, the practice is hard. The most prevalent failure point is simple inconsistency.
People just get busy.
Yeah. Teams will skip a month of reconciliations because they are overwhelmed with, say, a new product launch. They assume, oh, we can easily catch up and process 2 months of data simultaneously later.
I feel like skipping a month of reconciliations because you're busy is like ignoring a tiny leak in the hull of a boat because you're too busy steering.
That is a perfect analogy.
You just assume it's a minor issue you can patch when you reach the dock, but you're completely unaware the water is rising into the engine room. These errors compound aggressively over time.
That compounding effect is exactly what destroys financial visibility. If you misclassify a major software licensing contract in January, well, your operational baseline for February is already distorted.
Right.
By the time leadership sits down to do quarterly projections in March, the data modeling is entirely useless.
And people probably ignore those small compounding discrepancies because finding a missing $50 transaction takes 3 hours of agonizing spreadsheet forensics.
Oh, nobody wants to do that.
No. But the source points out an even more dangerous trap than procrastination. And that's rushing the closet just to check a box for the board.
Yeah, rushing is a huge problem.
I have to wonder, is rushing to generate reports actually more detrimental than simply admitting the finance department is behind and operating without data for a few days?
Rushing is significantly more dangerous.
Really?
Because operating a few days late means leadership is consciously aware they have a blind spot. They know they don't have the data.
So they can adjust their risk tolerance accordingly.
Exactly. But rushing and generating reports filled with unverified accruals and misclassifications, that provides a false sense of security.
The broken instrument panel again.
Yes. You believe your instrument panel is functioning perfectly, but it is feeding you catastrophic coordinates. By mid-year, your profit and loss statement is essentially a work of fiction.
Wow. And handing a work of fiction to a commercial bank for a line of credit extension or, presenting it to a VC firm during due diligence.
It's a remarkably fast track to destroying your professional credibility.
Right. So to prevent your financials from degrading into fiction, you have to establish a realistic operational rhythm.
You do.
The guide suggests the ideal target is closing the books within 5 to 10 business days after the month ends.
That's the gold standard, 5 to 10 days.
Okay, but I'm looking at this 5 to 10 day window. And if I'm running a lean, rapidly growing startup, taking my core administrative team away from revenue-generating activities for a full week just to stare at accounting ledgers sounds like a massive misallocation of resources.
I hear that pushback a lot.
Right. Especially with the proliferation of AI, machine learning, automated bank feeds. Why is a human team even deeply involved in this process anymore? Can't the robots do it?
Well, automation undeniably handles the heavy lifting now. Modern accounting platforms can ingest thousands of transactions and apply complex auto-matching rules. It eliminates days of manual data entry.
So why do we need the week-long human review?
Because algorithms do not understand business context.
Meaning the software will faithfully categorize a transaction based on the exact parameters you set, even if that parameter misfires in a specific edge case.
Precisely. Like optical character recognition might read a receipt perfectly, and an algorithm might see a charge at a high-end steakhouse and automatically code it as meals and entertainment.
Makes sense on the surface.
Right. But the software doesn't know if that was a legitimate client acquisition dinner that should be tracked against the sales budget, or if an executive accidentally used the corporate card for their personal anniversary dinner.
Oh, right. The software just sees steakhouse.
Exactly. Technology accelerates the speed of data processing, but the accuracy of the financial narrative still depends entirely on human review.
So technology supports the process, but it cannot independently validate it. It really functions exactly like an autopilot system.
Back to the airplane.
Yeah, the software keeps the aircraft steady at cruising altitude, right? It handles the continuous micro-adjustments of the rudders.
But you still require a human captain in the seat to look out the window and ensure you aren't quietly drifting toward a mountain range.
Exactly. And that 5 to 10 day closed window is designed to bring that human captain into the loop while the operational context is still fresh.
Yes. Because if you ask a project manager to clarify a vague $5,000 vendor expense 3 weeks after the project wrapped, they can likely provide the exact context.
They remember it.
But if you wait 8 weeks to review the ledger, that memory has vanished. And the finance team is just left guessing.
Left guessing, which corrupts the data. So building this into a reliable system requires moving it from a chaotic, end-of-month scramble to a dependable operation.
It does. And the Wilber and Longenbaugh blueprint provides some really actionable steps for establishing this architecture.
What's the first step?
The foundational step is rigorous documentation. The monthly close checklist cannot exist solely in the controller's head.
Oh, the old Bob is the only one who knows how to do this problem.
Exactly. Standard operating procedures must be written down. You have to create a clear, repeatable workflow that remains consistent regardless of who is actually executing it.
Right, so if your lead bookkeeper resigns tomorrow, your entire financial nervous system shouldn't just walk out the door with them.
Exactly. The system stays. Then, segregation of duties and strict accountability form the next layer.
Who does what?
Yes. You must define exactly who downloads the statements, who reconciles the accounts, who verifies the aging reports, and ultimately who provides the final executive sign-off.
Because if an entire department is generally responsible for the close,
then nobody is individually accountable when a material error slips through.
Oh, I thought Sarah was doing it. I thought Jim was doing it.
Exactly.
No.
Finally, leadership really must treat the monthly close as a business-critical system. It demands the exact same operational respect and resource allocation as your sales pipeline or your product development cycle.
It's that important.
It is. And if your business is scaling rapidly or your revenue models are becoming increasingly complex, attempting to just wing the process internally is a huge liability.
So what do you do?
Bringing in an external advisor or a specialized CPA firm allows you to build a customized framework that scales seamlessly with your growth.
Yeah. It takes this massive administrative burden and transforms it into a structured engine that just breeds absolute confidence.
The core thesis we keep returning to is undeniable. If you do not trust your numbers, you cannot trust your decisions.
That is the bottom line.
It really is. A rigorous, structured monthly close is the mechanism that delivers that unshakable trust. It allows leadership to allocate capital, hire aggressively, and accelerate growth with complete confidence.
You know, we spent this entire deep dive focused on how a clean close equips the leadership team with the confidence to steer the business.
Right.
But I want to leave you with a final thought to ponder. Consider the downstream effects of that rigor.
What do you mean?
Well, what happens when you begin sharing those highly reliable, rock-solid financials with your wider organization or your investors?
Oh, that's interesting.
Does the discipline of a flawless monthly close actually serve as the foundation for a highly transparent, high-trust company culture?
It definitely changes the conversation.
It does. When the underlying data is unassailable, internal conversations shift away from debating, wait, are we sure these numbers are right? To strategizing, okay, what can we achieve next?
That's a powerful shift.
It's massive. And that is something for you to think about as you evaluate your own financial reporting systems this month. Remember, you can check out more strategies over at www.mwwcpa.com. Until next time, keep your numbers clean and your decisions sharp.